All right, if you're a high income earner here in Canada, there's been a really significant change to our tax landscape that you absolutely need to know about. It's called the Alternative Minimum Tax, or AMT, and the rules just got a major facelift. So let's break down exactly what this could mean for you. You work hard, you do everything you can to minimize your tax bill, and you're pretty familiar with your regular tax return, right? But what if I told you there's basically a parallel tax system running in the background the whole time? It's designed for a very specific reason, and the rules just got completely rewritten. So, here's our game plan. First, we're going to demystify this other tax system. Then, we'll get right into the big changes for 2024 and figure out exactly who's in the crosshairs. We're even going to run the numbers on a few real-world examples. And finally, we'll tackle the biggest question of all. Is this money you're paying just gone for good, or is there more to the story? Okay, let's get into it. This parallel system we're talking about, its official name is the Alternative Minimum Tax, or AMT. Think of it like a tax floor. It's a safety net for the tax system. Every year, the government essentially runs your numbers two ways. First, there's the regular way, with all the deductions and credits you know and love. Then there's the AMT way, which is a much simpler, blunter calculation. You have to pay whichever one is higher. The whole point is to make sure that people with really high incomes can't use a bunch of tax breaks to pay little to no tax. So why the big fuss right now? Well, because starting in 2024, the government pulled all three of the main levers on the AMT calculation. It's a whole new ballgame now.
And what they did is really interesting. It's kind of this push and pull. On one side, they made it tougher. They jacked up the AMT rate from 15% to 20.5%, and they got rid of or limited a lot of common deductions, which makes the base amount of income subject to tax much bigger. But, and this is the huge change, on the other side, they massively increased the basic exemption.
That's right. The amount of income that's just flat out exempt from this tax jumped from a mere $40,000 all the way up to over $173,000 for 2024. And it's indexed to inflation, so for 2025, it's already nearly $178,000. This massive leap means the new AMT is extremely targeted. For most people, even those with high incomes, this number is basically your off-ramp. You won't have to worry about it. But for a very specific group, those other changes are a really big deal. So who exactly is in that very specific group? Let's pinpoint the financial events that are most likely to put you on the AMT radar. Okay, if your year involves any of these four things, you really need to listen up. We're talking about cashing in on a big investment and realizing a significant capital gain, exercising your employee stock options, selling a business using your lifetime capital gains exemption, or making a large charitable donation of stock. These are the exact transactions the new AMT is built to catch. Now, here's some good news. If your income, even if it's very high, comes mostly from a regular salary or from eligible Canadian dividends, you're probably in the clear. The math just doesn't work out to trigger the AMT in those cases. The system is really going after income that gets special preferential treatment under the regular tax rules. All right, theory's one thing, but let's make this real. We're going to walk through a few common scenarios just to see how these two tax calculations can play out in practice. Let's start with Chandra. She has a big $400,000 capital gain. Now, normally only half of that, $200,000, is taxable. But under the new AMT rules, the entire $400,000 gets pulled into the AMT calculation. This is a perfect example of that broader tax base we talked about. And even with that new high exemption, it means she ends up paying an extra $4,000 in tax for the year.
Or look at Eugene. He's making a smart, strategic donation of stock to charity. Under the regular rules, there's no tax on the capital gain for the stock he donates. It's a great incentive. But the new AMT says not so fast. It pulls 30% of that gain back into the calculation. That, plus a less generous donation credit under the AMT system, means his AMT bill is way higher, to the tune of over $8,000.
And stock options? Oh yeah, they're another huge trigger. So here's Fareed. He has a $400,000 stock option benefit. In the regular system, he gets a 50% deduction, which cuts his taxable income in half. But under the new AMT, that deduction is completely wiped out, gone. The full benefit gets taxed, and that's a massive change that can very easily push you into paying AMT. So after seeing those numbers, you might be thinking, wow, so if I get hit with this tax, is that money just gone? Well, the answer is usually no. And this brings us to what is maybe the most crucial part of this whole story, the recovery mechanism. This is probably the single most important thing to get your head around. Any AMT you pay creates a special tax credit. You can then carry that credit forward for up to 7 years and use it to lower your future tax bills. So in many cases, it's better to think of it as a prepayment of tax, not an additional tax.
Here's the play-by-play. Step 1. In a year where your AMT calculation is higher than your regular tax, you pay the AMT. Step 2. That extra amount you paid becomes a credit that sits in your tax account with the CRA. And step 3, in any of the next 7 years where your regular tax is higher than your AMT, you can use up that credit to pay your tax bill, effectively getting your money back.
So what does it actually take to recover that cash? This table gives you a pretty good idea. For example, to get back, say, $40,000 of AMT you paid, you'd need to have about $229,000 of regular taxable income in a future year. And that's the key. You need years with high regular tax, like from a big salary, to create a big enough gap between your regular tax and your AMT to soak up that credit. And really, this is the bottom line, taken straight from the CIBC Private Wealth Report this analysis is based on. They believe that for most people who get hit with AMT, it's really just a timing issue. With some smart planning, you should be able to get it all back. The only real risk is for someone who has a massive one-time income event and then very little taxable income for the next 7 years.
So the main takeaway here is that while the new AMT is very targeted, for those it does affect, its bite is real. It means you have to be much more proactive with your planning, especially around the timing of big income events like selling assets or exercising stock options. And it leaves you with a really important question to ask yourself. Is your financial plan ready for this new reality?
I really hope this breakdown has helped clear things up. If you think you might be affected by any of this, it is absolutely essential that you talk to your tax professional to run the numbers for your own unique situation. Thanks so much for tuning in.